Hello, folks. Dave Russell, VP of Market Intelligence here at TradeStation, and welcome to our Market Trends webinar every Thursday at 2 p.m. Eastern. Just start off with some disclosures here, and if you have any questions, please use the chat in Zoom. We'll post a few things into there once some more people have joined. You're also going to start off by going to TradeStation.com. We have a rundown of the things we're going to be discussing. If you go to the research tab at the top of the TradeStation.com main page, and then you go to the insights link, you will see an article. I'll show you in a second, but the article has a Wall Street sign, and that contains a bunch of materials that we're going to be using, and that includes some downloads. I have a new indicator for you guys that I wanted to share, kind of in the spirit of borrowing from what we have and adapting existing code, which is one of the ways to kind of create things is simply to take what already exists and to expand it. And that's what we're doing today with a new MACD based indicator that I'm going to be sharing. All right, folks. Good. All right. So as usual, let's go to this. First, go to TradeStation.com. Well, just show you how you get there if you don't see it. If you're on the main TradeStation page, go to Research, Insights. By the way, they have just lowered the margin rate on micro S&P futures as well. So that is a lower day trading margin rate if you're trading futures. Although at this exact moment, S&P futures might be pretty boring to trade. Volatility is absolutely nosediving, which is one of the things we're going to talk about. I think the first thing we want to talk about is, once there was a little girl who went into the woods and she found a house with porridge in it, and we all know her name is Goldilocks. And this is, I think, really the story that we have now. The overall situation when you go into the data we want to just kind of view today. First of all, today, initial jobless claims rose to the highest level in over a year. When you take a look back at some of the data we've had now in the last week, what really stood out, there's a bunch of things, but all of them essentially are pointing toward lower inflation and a Goldilocks environment where the Fed, they've already telegraphed that they're not going to raise, that they will probably not raise rates, next week. But the question beyond that is, will they ever again? And I think they're not going to want to commit to that. They've already kind of put their foot in their mouth one time too many, saying inflation is transitory. So you have to remember that political sort of, PR angle of it. But look at some of the data we had. First of all, unemployment was higher than expected, wages missed. What was also interesting was, if you look at the ISM manufacturing, I need to actually pull this up. ISM manufacturing report on business. I mean, this was really interesting. If you look at this, if you just look for ISM manufacturing report, I mean, they said stuff about prices that I've never seen them use language like this. It was pretty interesting. Silliness. Dramatic was the word. Look at this. The prices index fell back into decreasing territory and in dramatic fashion. Okay, that's kind of interesting. And then we saw also productivity was revised higher for Q1. When productivity is revised higher, that means that inflation is less. So now we just have a lot of things here where it's getting difficult to really see, a strong kind of, I think at this point, it's getting hard to see, a huge case for further rate hikes. It's also interesting is OPEC cut oil production. And if you look at oil, it just cannot hold a rally here. So, I'm not sure oil goes, much lower in the situation we're in right now, but we have an environment right now in this market where essentially, a lot of the things that we've been talking about for a long time have kind of played out. And I think when you look at it, a huge story continues to be just the fact that China is a lag on the economy. And a lot of people don't really think about these big trends, but if you look at the 1980s when inflation came down, people talk about Volcker, but one of the huge narratives was the fact that a big chunk of the global economy was in a 10-year recession, which is Latin America and Africa. and global demand for energy fell at the very same time that Russia started cranking out huge amounts of oil. So what do we have now? We have, instead of Latin America in crisis, we have China facing a debt implosion, not that different from Latin America in the 80s. People aren't going to say it now, but there's clearly weakening in China, and the thing is not, it's just not coming together. All the data is pointing toward just real sluggish pain in their economy. And what do we have? We have Russia hurling oil at the global economy. So that is a deflationary Goldilocks environment, and the pieces continue to come together on that. So I think this is an important context we have to remember here. Now let's take a look at the VIX. The VIX went to the lowest level. I'm going to pull up a weekly chart here because it'll be easier to see. This is on my swing. I'll actually show it to you in a second, but this is the weekly of the VIX, and the VIX is now back to where it was in February of 2020. That is the lowest level. I mean, it might actually be slightly below that today. I'm not sure. We hover, the low was 1338. The low this week is 1353. But this is a collapse of the VIX. Something else very interesting just came out today, the American Association of Individual Investors. Look at this. 29% bullish to 44.5% bullish. That's the sharpest increase since November of 2020, 15 percentage points. It's the biggest increase since the election of November 2020, the last presidential election. The decrease in bearishness was the biggest increase since November of 21, I think it was. I put that down somewhere else. So we have a lot of pieces coming together now that just seem to be continually confirming that there is cash on the sidelines. And not only is there cash on the sidelines, but there's simply no leverage longs to unwind. And I think people underestimate very often that one of the things that causes violent market sell-offs, like you look at, October of 1987 or others, was the fact that people are leveraged long and things go down and they start getting stopped out and it unwinds violently. Well, when you don't have that kind of, potential for an unwind of leveraged longs, you don't get the same volatility to the downside. You don't get selling pressure. And that's where you're in the market right now. No selling pressure. In fact, you get the opposite. I just have to mention, this is one we had talked about many times on Market Insights, Carvana. This was a short squeeze. It was kind of interesting. We had been mentioning from a while back here. What's interesting, you take a look at Carvana. I'm going to really quickly pull up. I'm going to just do a real quick, intraday chart on this with let's do CVNA with, this has got 4-hour bars, which is actually good enough. Let's go here to drawing Fibonacci price retracement lines. From here to here, 50% holds. Okay. This is what the 50% retracement tool we were showing, and it played out pretty well. So you go to drawing Fibonacci price retracement lines. I did this yesterday. Where did I see it? It was right. Yeah, look at that. So basically what you're looking for is, you look for a period of stability and then you get a jump. So you have to identify the jump based on, the close before the big move happens. So in this case, this was a sideways move and then you get a jump. So that's your impulse, your first piece. Then you get retracement and then you look for, basically, you'll notice after that, after that moment of that high was made, we really never closed, below that 50% line. We held it and then we continued higher. Then you come here and you look, and basically this was a side, then, all right, so, that was a bullish sign of, potential opportunities to buy down there. Then you get your impulse off of that, and then it pulls back and holds 50% of the impulse, that thrust. And this is your classic use. We've been, emphasizing the usefulness of 50% retracements in Carvana on the short squeeze. This is exactly what we're talking about right now. When the VIX goes down and the Fed moves toward pausing, people who are short these leveraged names are going to be in trouble. So look at American Airlines, got the most short interest, got a ton of debt, and squeezing higher. This is the sort of thing. Look at the cruise lines. Same sort of pattern. This is Norwegian Cruise, Carnival Cruise breaking out the top of this, recent high from earlier in the year. We did a trading view idea on this, but this is what we start to see in a falling volatility environment. The short names, the leverage names. You're going to start to get the garbage or the fraud. The lower quality stuff can start to scream higher. And I think that's pretty interesting. What's also interesting to me is today we had those weak jobless claims. Look at gold. It simply cannot get a rally. This is the GDX. And I think this is also telling you something. Gold is pretty much, the opposite of stocks. Gold usually, it's not to say gold goes down in a bull market for stocks because it, has gone up somewhat. But the thing is that gold underperforms during secular bull markets and it outperforms in periods of bearishness. The inability of gold to rally here, when you consider what we're seeing with the jobless claims and everything else, I think it just tells you that sentiment-wise, people are, the people are looking out, they're saying, I don't want gold, I want this. And I think that's really, people want Goldilocks, not gold. And that's really what we're going to see here. And that doesn't mean that gold is going to go down a lot. I mean, if you look at, this is the GLD, you can see something of like a double bottom here with these kind of kicker candlesticks, at this 180 level. Gold, there's an argument for it going higher, but I think the bigger point here is that people are looking out and they're seeing the Fed is pausing, the debt ceiling is resolved, there's cash on the sidelines, and it's hard to really take a 6 to 12 month view and feel bearish, I think. And I think that's really kind of what we're seeing in the market here. All right, so let me go into some other stuff. Let me now quickly just go back to show you, this is our rundown for today. And if you go to the top of it, we have our normal tools are here. Now, if you open, this is a zip file. If you open the zip file, you will see the most recent one is this, the May. It has a bunch of these materials. It has these ELDs and these workspaces that I'm working off. I also added today, the new one is this, if you go to this second one, I don't have the zip here, but there's a second one, which is a thing called MACD cross days. It's a new indicator, and I'll be showing it to you in a minute. Let me just kind of go through this. I will say some of my normal signals are not working massively well. I've been kind of, looking at things squeezing up from the lows, and I found that some of these things with like simple retracements and stuff have been working better than some of the signals that I've often kind of worked with. But let's just very quickly take a look here. Wow, this is nuts. See, it's breaking through this level. Remember, we identify 7 catalysts for stock movement: volume, margins, investor rotation, macro trends, strategic actions, turnarounds or transformation, and credit. This is a credit story, okay? This company's got a ton of debt. We know that because we can go to our fundamentals tab and we can go down here and look at, I'm going to just add Carvana. This is the S&P 500, but CVNA. If you look at this, is an indicator I created, but it's basically just a poor man's version or an everyman's version of some other basic balance sheet analysis, and it's enterprise value to market cap. The higher this is, the more debt a company has. So you can see these are banks that kind of have the highest, which you'd expect. But there's American Airlines, there's Carnival, there's Norwegian Cruise, there's Ford. These are some of the names that have that ability to squeeze, and they have been. Ford's been squeezing, which is kind of interesting. It tried to break kind of this bearish, it had like this kind of, looked like a bearish triangle, and then it just refused to break the downside. And then if you look at the ones that have the lowest reading, you see basically a lot of our companies that are much better capitalized. But that's not always good. Quality is not always good in an environment when sentiment is getting bullish. It's often the down in quality trade that will give the high returns. And I think that's what we're kind of seeing here. So using our fundamentals tab on the MT main workspace, which is included in the zip file, after you loaded the ELDs, this is a proprietary indicator I created, or a custom indicator. Looking for stuff which has an EV to market cap that's on the higher end will help identify the sort of leveraged opportunities. Okay. Are you saying that once a week we should refresh the zip file from the Insights website? No, just every time that I publish. So basically the way I'm doing this now is when you once a month, I'm creating a new master zip file. And I didn't do one for June because I didn't have any additions. So the most recent one is May. So I'm always going to have the master zip file, which I update roughly monthly. But then during the month, if I come up with something new, I'll add it here. And then the following month, all of those additions will get amalgamated into the next one. So if you go to the current main one here, it includes a bunch of additions that I had previously made in the middle of the months. So just look at the most recent, you just go to the website and go to market trends as the category. If you're actually on the article itself and you click on this market trends category, this will show you all the most recent ones. Just look for the Wall Street sign. I only use this thumbnail image for for this particular rundown, this article, and it will always be at the top. All right, let me continue with this. So anyway, this is the reason why we have different tabs here. We can do stuff based on, technicals, but we can also sometimes just look for fundamentals, because there are times when we came out of the election, I can't remember, we were doing this at the time, I think, as masterclass, but we were saying back, after the COVID, it wasn't the election, it was really the COVID vaccine, late 2020. It was suddenly people dumped the NASDAQ and they started buying value stocks. They bought industrials and financials and energy. And what we were saying at the time was, you look for stocks that were trading under book value, low valuation stocks, and they did scream higher for a while. So that's kind of the way to be thinking about this. And the nice thing I like about EV to market cap is it's a pretty universal thing for different sectors. And that's why I call it an everyman kind of, you don't need to have a CFA to understand this. That's what I like about this indicator. It will work. Just realize that financials are going to be more leveraged because, they include, the deposits on their balance sheet as liabilities, makes them look more leveraged than they maybe are. But the key thing is, by having the sector indicator showing here as well, we can quickly kind of, we expect to see financials, but then when we see something else here, then we start to kind of realize, that's different. So it's good to always be looking at key ratios in the context of industries and sectors. When the VIX is low, it's time to go. When the VIX is by, that's, I think, partially true. I think one thing you have to be careful of is, like a lot of things in the market, when something is high, it often goes higher. And when it's low, it often goes lower. So just because it's low now doesn't mean that it's going to just instantly start to go. My view here, I'm going to show you something else, but I would say here, let's go back to a weekly, the MT swing. This has weekly charts. If we go back to the VIX on this, and what I would say is, if you look at historically the weekly chart of the VIX, the way it usually behaves over time is, it grinds down. And, from my perspective here, I would imagine that historically it has, been under 12. So my sense here is that things are gonna get more optimistic before they get more pessimistic, especially when you consider this just now happening. You got to realize that sentiment has been negative for a long time. I don't think it's important to realize that, that when you talk to most people, I tell people I think the economy is great and we're entering a great bull market, and they think I'm nuts. But the fact is that all the data supports it. And I've been saying this now for last year, but look at how negative some of these things were. And I think right now, other people are going to, I believe, and I'm not saying this out of arrogance, but I'm saying this because the data has been confirming what I've been saying. I believe that my view is going to become mainstream. So from my perspective, now is the time when the bullishness will widen. Now, on that, let's take a quick look at one of the things that I had actually put here. Recently, remember every Monday we do an S&P recap. We look at important trends, and in this one, and I guarantee you, look anywhere you want. Maybe I'm wrong. I don't think you're going to find any economist who has mentioned this yet. But wait 6 months and they'll be talking about it. All right, we talked about this a week or two ago, and I'm telling you, this is a big deal. This number here. This is from the monthly construction report that comes out of the Commerce Department. The most recent one was April. It comes with a big lag. This came in late May. All right. Inside of the construction report, they say stuff like construction on residential, construction on highways, blah, blah, blah. It's got like 15 lines. One of those is construction on factories and manufacturing facilities. And this is it from Fred right here. If you want, I'm going to just paste this into the chat. If you guys want to see this, this is from the St. Louis Fed, which is where this data, they have a nice tool that I think everyone uses it now. Anyway, if you just go to this graph and you go to change it to percent change from year ago, you're going to see basically what I'm talking about. We doubled in April 23 versus April 22. It increased by 104%. Okay, so 105% or something. So I'm telling you, the American economy is reindustrializing. The impact that this is going to have on incomes and economic growth is going to be dramatic and long lasting. And this is very interesting. So this is, I think, another thing we had to kind of remember. We have right now a lot of positives happening. So let me actually just kind of show this. I actually wanted to highlight this. I kind of have some, I try and keep my own, points. So I kind of keep my own head straight, because sometimes, you have to look back and say, what is really happening now? And here's kind of the outlook that I essentially have. And one of the reasons why I think it's going to be difficult for the bears to take charge again. First of all, like I mentioned with Goldilocks, when I talked about things like the ISM numbers, when I talk about things like the inflation, the wages, interest rates at this point, I mean, there's a decent chance to argue that they're going to go lower in the second half of this year. Now, I could be wrong, but when you look at inflation, if you look at the CME, it's not super clear yet. This is the CME Fed watching tool. Now, what's interesting about this is, and I think in some cases, this is actually, and I'm not the only person saying this, the data has been, I think, distorted by the debt ceiling and the flood of borrowing that the Treasury is going to do right now. So basically, the government did not issue a lot of debt before they were raising the debt ceiling. And as the whole world said, all these bond traders basically were shorting Treasury, saying that Janet Yellen's going to flood the market with debt. And that's what apparently is happening now. I mean, bonds are not that interesting. You just have to realize they're in the background. Anyway, once that passes, the short-term rates could start to fall. And when that falls, these numbers are likely to get more kind of in line with the economic data. So right now, we're not showing a significant expectation of rates coming down. But from my perspective, there's a decent argument to think rates are going to come down in the second half. When you look at the inflation data, when you look at the employment numbers, when you look at energy. All right. So the thing is, on one hand, you have value opportunities where you have these banks that have gotten hammered, but they're at low long-term valuations. You have the industrialization thing I was just talking about. Then you have the giant catalyst of AI. And then on top of that, you have in the housing market, you have a very positive supply-demand environment. And then I think it's very interesting that nobody talks about, but it is a very valid point, is that European equities remain very cheap historically. So if you look here at the MT sectors, I'm going to get back to this thing with SMH, but if you look at the EFA, and we've talked about this, EFA is the global ETF, is mostly Europe. It is still below. This is the MT sectors. This is still far below where it was in 2007. The valuations on a lot of European stocks are far below And if you look at this, this has lost traction against the US for so long. So the thing is if we are actually entering a new period of dollar weakness, which there's reason to think we might be, you know, let's actually bring over this trading view chart. This is a euro. Look on a weekly chart. Let me just show you this thing I was looking at on the euro here. We go to our parallel trend line. Look at the parallel channel. Look at this. So let's see. This is a weekly chart. And when you look long term here, I mean, the fact is that the euro in the long term is actually still in an uptrend. So when you look at this, the dollar is historically in a downtrend. The thing is if we are actually at a point here where we're going to have downside in the dollar, that's another tailwind for equity. So right now, when I take a look at this, I see a lot of things here that are structurally positive, and I think these are factors that I have actually kind of taped up on my wall that I'm bearing in mind, because these are things that there's reason to think that these are going to remain as catalysts for the foreseeable future. One thing I want to just mention, all right, let me go here. All right, caution in chips. I'm just working through this, but let me just show you one thing here. I did have this up. So this is one of the things that is in our zip file that we share with you guys, the SMH. This gentleman over at Citi named Chris Donnelly mentioned the fact that he said that the semiconductors are at one of their highest valuations or relative to the S&P. I think he said since the financial crisis. He was on CNBC earlier in the week, and he was saying, sell chips. What's interesting to me is that this kind of shows that when we look. What this shows is this is the SMH, it's not the SOX, but it does show you that this is the ratio of the SMH against the SPY, and it shows you that in many ways the semiconductors are at a point where they are, as a ratio against the broader market, you could say overvalued. That's just purely on ratio. It's assuming there is mean reversion. What is also interesting, though, is if you actually look at this, the world's semiconductor trades at 6. If you actually Google this, and you look at the news that it generates, and you go to news, you can actually see these guys lowered their chip forecast. So there's actually right now, and there's one thing this guy, Chris Donnelly said, was he actually said that, a lot of the internals of the semiconductor industry are not that hot right now. And again, where is the weakness? China. That is, and I think that that's something that is, as time goes on, the Chinese weakness remains a sort of thing to think about. Although one thing that I think is interesting is that just because China is weak doesn't mean that it hurts Tesla or Apple, especially not Tesla. So I think it's just kind of interesting that it doesn't necessarily hurt American companies with Chinese exposure. All right, let me just finish rolling through these items here. I mentioned about the VIX. All right, let's go to our actually, let's look at the chart I did. So this chart, what I did was I combined several things that we've been doing, and it has the advanced decline line, which is in our MT breadth. What I did was I took two different things. I took the advanced decline line, which we see here. There's this real kind of improvement in breadth in the last few sessions, and this was really when we saw this surge in the banks and the financials, and they really dragged up breadth. And I think that's one of the things to remember is that look at this. I mean, this is forming. This is not pulling back at all. This is very interesting how tight we're holding here. I'm just looking at my other screen at some stuff. This is a pretty impressive price action. Coming into something like the Fed, and this is basically, what I've been looking for, which is essentially very little pullbacks. The model I'm working with, I keep jumping around here, so let me just finish what I'm saying. The breadth has improved, okay, and you could argue when you look here at this chart, if you look at a Keltner channel, you could argue that the S&P is overbought, based on the Keltner channel. This is the Keltner channel. If I just go here to SPY and put it on the Keltner channel, you can see we're above the Keltner channel. That's an argument we're overbought. Now, usually, or very often at the beginning of a move to the upside or downside, you will get an overbought or oversold condition, which is followed by not mean reversion, but simple continuation. And based on the other things I've said, that's more the sort of thing that I'm kind of thinking here. It's interesting to just kind of see how we're just holding here. But I did want to mention that it's kind of just, potentially overbought in the near term, but that is not necessarily any kind of bearish signal. I would not read it that way. I'm just looking here at these items. I mentioned that we all know the Fed right now has essentially telegraphed skipping rate increase next week. I mentioned how value and cyclicals have taken the lead as a new month begins. And I think that's also a little bit of the investor rotation thing we have to be kind of thinking about here. There are periods of times when investors flock in and out of certain sort of sectors. And, we had a massive liquidation of financials and banks at the end in March. And now the question is, will people come back to them? We also had a bearish outside candle on the NASDAQ, but honestly, it was just probably overbought. This is what I mean. Some of these signals, when you get into kind of more of a bullet, the market really gets more bullish. You have to be careful with making too much of any individual signal. I mean, it's pretty interesting to kind of look at something like the NASDAQ had just simply gotten overbought. I think, all right, let me just show you some things I want to mention here. This is the euro. Let me show you the S&P on a weekly chart back in 1995. And I know that sounds like ancient history, but I mean, 1995, what did we have? We basically had the Fed pause and the market took off. And look at this price action at the time. And I think that is actually what we could be setting up for. You'll notice that once we broke out, there was really no pullback. It was a very tight move for a year. And, the reason is when you have a period of sideways movement, there's really no one who's really needing to take profits quickly. So, I think that history doesn't exactly repeat, but there's some real similarities between this moment in 94, 95. I also think when you look at it demographically, we're in the same spot. I was actually trying to look at the birth trends, but basically baby boomers, I think we're an average, the average baby boomer was at a certain age here, and the millennials, are like 2 years younger. So the thing is the average millennial was born in the year 1990. So you actually have people now who are like in that period when you start to have family formation, long-term savings, college savings, everything else. And, that's another similarity. We're in a similar spot in that sort of demographic cycle as we were in the mid 90s. And a lot of the thing in the mid 90s, late 90s, it was fueled by the influx of baby boomer money into into 401ks and stuff. Now, here's the thing we did on TradingView, which is similar to this. And this is quarterly candles of the S&P 500. I wanted to share this because basically, if you look at, this was the bull run of the 90s, and this was the pullback I was just showing you. This is 3-month candles, very long-term quarterly candles on here. But you see, we pulled back and held the channel and then continued. Well, look here, it's like there's also this channel that in many ways, the Fed hikes and we pull back, and then we hold the channel. Back here, Fed hiked, pull back, held the channel, and continued. So, in my view, if you measure this lasted 76 quarters, and we're right now not at 76 quarters. We're probably, I don't know, maybe 40 quarters in or something. If you project the same length of time that we had between 1982 and 2000, it takes you up to the end of this decade. So one of the reasons why this chart looked so bullish on the weekly chart or on the daily chart when it was a very strong uptrend between 95 and early 97 was because of the fact that on the quarterly chart or on the very long-term chart, you had this trend in place, and we were coming off. And so to look at these long-term things, they're not going to give short-term trading opportunities, but they kind of help you realize that when you're coming off something like this, these are the moments when, greed is good maybe. And these are the times when fear is more warranted. But greed can be good when you're coming off these sort of periods of the long-term trend. All right, questions. All right. Just looking at, there's no more questions there. Let me just go back to my. So I always kind of emphasize a mover of the week. I think Carvana was one of my movers of the week a few weeks ago or a few months ago. My Lord. Anyway, Mongo database. Now, again, these are just companies that are just kind of interesting. A lot of these software companies are going to find ways to put AI into their products. But a lot of these, you got to also realize these are stocks that, really got hammered. And for people looking at them from a long-term growth perspective, these are things that you could argue, hey, Mongo database has gone nowhere for 3 years or 2.5 years, because here it was in December of 2020. So, for people with a long-term view, and you look at Microsoft in like 1992, it did things like this. And people who are long-term growth investors start to see things like this, and there could be names like this sometimes have continuation. So I wanted to just kind of show, this is one that popped up. This company went public a few years ago, and it's a relatively new name, and it's in that kind of that spot where, let's see what its market cap is. Mongo MDB, looking at a market cap of like 26 billion. So it's in that kind of spot when it's not that big yet. If you look at its price to book, it's a high valuation. But these are the sort of things when people are looking for growth names, these are the sort of names that people can kind of look toward. The big names work, but these smaller names, when people saying, what is going to be the next member of the what's going to be added to the S&P 500, what's going to be added to the NASDAQ 100, they will be looking to names potentially like this. So I wanted to kind of highlight this. We always try and look at once a week a kind of really interesting mover that's not normally on the radar. I got to be honest, a lot of these signals that I have on this one just didn't really look that great, and I don't really want to get into them too much. These are based on some of the things I try and look at stuff based on what I see the night before, and excuse me. And a lot of these signals that I've used recently haven't worked super well. So I don't really have, there's not, let's just take a look at maybe MSI is the one that's maybe interesting. This is an interesting sort of, it's kind of an industrial name, kind of a tech name, but they've had some interesting earnings and stuff. And here it is at the bottom of the Keltner channel. Trying to look at some of these others. Borg Warner was interesting to me because of the strength, in like Ford and GM and stuff. But I'm not really sure about some of these signals I've been looking at. On Semi had hit a new 52-week high. It's interesting just to see how it kind of been coming off, the 8-day exponential. But none of these signal scans are showing a whole lot of interest to me now. All right, so upcoming events, CPI on Tuesday is big. The Fed with its dot plot on Tuesday. Powell's press conference. In my perspective here, we're in a spot where in some ways it's kind of like, I don't know, if you have a child and the child graduated first grade, the child graduated second grade. That's not news. The kid is growing up, and we all know that you go from one grade to the next. And I think where we are right now, when you look at the things I've said about inflation, the Fed is just going to sit and watch at this point in time. The exact events of what they say don't matter. The thing is, does the kid get held back in second grade to third grade? Do we have a hot report here or there? The Fed is going to be sitting and watching those numbers. And at this point, my perspective is the dot plot is going to be non-committal. They're going to sit and watch to see confirmation, and the market will essentially hope for those things to happen, because now when you see this turn in sentiment, this is a structural change in overall sentiment. In my view, this is something now where with the VIX at this level, the bears have, this is like, for the Germans in World War II, this is the fall of Stalingrad for the bears. When we go through these levels, at this point, it's hard to really see, something that will, undo this. That is not, it has to be something totally surprising. When you look at the normal forces at work now, they favor kind of an increasing sense of confidence. It's not to say it will happen, but when you look at kind of what's out there at this moment. So I think my point in saying that is, I actually expect the Fed to become less of a catalyst going forward, and they just kind of go back into the background. And at some point, we could be talking about a rate cut, but at this point, it's more a question simply of the panic easing and normalcy returning. We have quad witching next week. We have retail sales. Again, none of these numbers, in my view, are really the story. The story really is just the trillions of dollars that are locked up in money markets trickling back into equities. And that's really the story that's happening now. Like a child growing up, it's not news when they graduate from first grade to second grade. It's just the normal process of time passing and processes playing out. All right, so the indicator that we gave you guys was something called, I'm going to add it to a radar screen to show you how it works. I have a radar screen here. I'm just going to show it. And this thing was called MACD cross days. So if we go to study, what I did was I took MACD and I basically, I'm going to remove this. I'm going to just add very quickly here the S&P. All right, go to studies, go to data, add symbol list, S&P 500. All right. Uh-oh. Hope I didn't crash. It's building. It's coming. All right. So, I like this because I don't even have, I'm going to add MACD to a chart, and then I have some options ideas for you guys. I'm going to get to in a second. Studies, MACD. You can actually add this to a chart. MACD and MACD cross days. Let's add that. Add both of them. So, I should have made it as a histogram. I apologize. I'm going to go to style and make it a histogram on the chart. I love these colored histograms. Anyway, so what this does is this shows how many days MACD is rising or falling. The histogram, how many days is positive or negative. And the idea, this is gold, but let's look at something like, I don't know, let's probably work for something AMD. So anyway, with something like this, the idea would be to find, you get the MACD when it turns positive. The opportunity is often, 5 to 10 sessions after you get the MACD turn, and it kind of goes up, and then you get a modest pullback. And looking for things that have a MACD, so basically, it looks for how many days since it turned positive, and it simply counts. So in this case, it's like, it's the value here that says crossbars ago. At the bottom of this little pop-up box, it says 3, 4, or 5, right? So when you often get, if you have a positive, a reading between like 0 and 10, that's often going to get you after the bullish thrust occurs or the bearish thrust occurs. So you can sort, and then you can basically say, I want to look for the stuff that has, basically a value, that is, less than 10 or something, right? You can just erase everything above. And then you can also do the same where you I like to sort things in radar screen, and you can just say like, I want to erase everything that is, negative. And then it's going to tell you stuff here that had recent bullish, signals on. Oops, let me make these symbol link them. And this will be, see Royal Caribbean, for example. So very often for things like this, the idea could be to combine it with a study like 5D, and look for stuff that is actually negative on the 5D, which is the 5-day percentage change, right? And so this could potentially work on Royal Caribbean, for example. Now, you want something that's probably down more than this. These are not very big. Wait a second. Just to make sure I'm doing this with a daily. I apologize. I had that set for 5-minute candles. I hadn't checked that. So if you look for stuff here, now these numbers are going to be all wrong. Actually, I apologize. I should have checked that. But the key thing is MACD days cross, you know, when it's going for a long time, it's often near the end. But if you look for stuff, the second it happens, you know, within that kind of 10 window period, the opportunities sometimes do pop up. So for something like, you know, name like a Royal Caribbean, or, you know, for CCL, look, it would have come up here. So we actually did a trading view idea on CCL recently. So I did want to mention this because CCL it trades a lot of options, which we like to see. So let's take a look at the Option Station Pro here. And I was looking at CCL. And what's interesting about this name is, let's go over here to our MT main for CCL. You can see that it's supposed to report earnings. This is estimated for the 23rd of this month. So one thing that I'm kind of thinking, it's a little bit overbought here, but you know, something people might kind of consider doing is watching it next week and waiting for the confirmation of that earnings report. And then something like, you know, a call spread, you know, targeting something like the 14, something like, you know, a 13, 15 or something like that, is potentially interesting. American Airlines also kind of extended here, but when you look at this, you know, if things are, you know, kind of moving higher, something like this targeting something toward the July 16 to 18 strikes. And we look in July of American Airlines. These are things like after the Fed, they might make sense as well, or any kind of near-term weakness. But a name like this is kind of just starting to move. And the thing is that these had a strong surge, and then they got really beaten down when we look at the, you know, the banking crisis. But American Airlines raised their guidance last week. So it's kind of interesting to see this. This was actually a guidance raise right here on, it was right in here somewhere. Somewhere in here, they raised their guidance. So something like American Airlines, they report earnings on the 20th of July. So, you know, from this, I was kind of looking around this expiration, the 21st of July, and something along the lines of like the 16 to 18 vertical. You know, this vertical is going for around 42 cents. And if it chops around a little bit more, you know, it might be around 40 cents for a $2 wide, you know, for basically around 40 cents for a spread that can widen to $2. And, you know, a name like this, they've already raised their guidance. You know, something like that might be an interesting risk reward to take a 5-to-1 risk reward. Another thing I'm watching here really are the banks. I've been watching kind of a name like Bank of America. You know, in my view, something like the 30 to 32 call spread in July, which would target the earnings report. Now, another thing about something like this is that someone might want to simply look at something like the July 30 calls, because those calls will likely hold their value through earnings. So something like, you know, calls like that, they essentially, if they have a delta around 40, it means they'll essentially, for every dollar, they'll move up 43 cents. So they're going to provide some interesting leverage on the underlying shares. And, you know, the thing about them is, with the earnings report coming on the 18th of July, usually what happens is volatility drops after the earnings report. So they often do not have significant time decay into the report. So it's a way to kind of get the delta, get the tracking of the stock without giving up the, without having that time decay hit you. Another one that popped up for me that was kind of interesting was Walmart. Now, this company is, I think, in a really interesting spot. And honestly, I think this is one of the best and most interesting fundamental stories in the you know, kind of in the broad world of non-tech right now. Their earnings were really good, and they are just destroying everybody from what I can tell in market share. Costco, Kroger, Walmart is killing it. And what's interesting is the 155, the August 155 calls of Walmart, which would target that earnings report. You know, these are kind of an interesting sort of, you know, $1.47. You know, these are the sort of calls where, you know, they can track the shares, and if the stock kind of proceeds to new highs, when you really look at this, I mean, I don't know. This is just interesting to me, the way it's forming this basing pattern here. It pulled back and held this level. Let's actually do a little bit of Fibonacci retracement on this one. Fibonacci price retracement lines. You know, again, the magic 50%. Fascinating. But, you know, this is sort of thing to me where, you know, moving back to those levels, when you consider where the market is, when you consider their fundamentals, and you consider the catalyst of something like earnings, that's an interesting sort of thing that could be interesting. Another one, let me just take a look at this one, is Oracle. They have earnings next week. You know, people kind of forget that Oracle is just quietly cranking to new highs. This is a weekly chart of Oracle. Let's just confirm that earnings on Oracle are on the 12th, which is next Monday. So people looking for this could do something with the weeklies of next week in a name like Oracle. The 16th of June's. So this is interesting to look at, see the reaction to some of the earnings. I'm just I'm not sure exactly what's spread in this one, but this is one they have on the radar. They've had some really interesting numbers. People forget about Oracle, but they acquired Cerner. Cerner is a health IT company. And they also have, the lady running Oracle seems to be just really smart. She doesn't get that much attention. I'm not really sure why, but she seems to be really smart. She's Israeli, I think. Or she has some kind of I think she's Israeli, but she's really smart. And this stock is one that's been under the radar. They report earnings next week. They trade a lot of options, and people might want to, you know, this would be one of people looking for, you know, some sort of option plays, some vertical spreads in a name like this, something slightly out of the money could be a sort of risk reward, way to manage the, you know, if you are bullish, you're looking on something to the upside in this. I'm just looking here. Those are most of the things I wanted to cover. So anyway, great to talk with you guys. And is there any default setting for any short-term opportunities for day trading? I'll tell you, the one thing that was most popping up to me right now was I'm looking to see if Wells Fargo breaks this level. Like I said, I've seen a lot of these other names that have been kind of breaking through to the upside here. Look at what we did, United Airlines, right? Over on TradingView here, we did an idea on TradingView, and this one, and this triangle in United, and it is continuing higher. And to me, you know, these are similar. These are cyclical stocks. Look at how the charts march. This was United. Look at Wells Fargo. It's similar. Sell off in March, series of higher lows. You know, squeezing here. So if there's anything right now, Wells Fargo would be the one that looks to me like it could have a little bit of an opportunity. I was also just looking at the pullback in Microsoft. This is kind of interesting to see if this sort of stabilizes. But anyway, those are the main things I wanted to show you guys. You know, I will also remind you that we had created this crossover strategy based on the number of stocks with the 20-day against the 50-day. And then we talked about this at different points in time. This was expanded from our breadth workspace, and it has really been an interesting strategy. But this is interesting how once again, we had the crossover here, and this is now in a bullish status. If we look at historically strategy performance report, this strategy has been a moneymaker. So right now it has a long position. It had a bullish entry signal here, based on this, and it has been working recently. So this is another thing to look at. You can see this when the blue is over the red. And what I did here actually in today's blog post was I turned those two into a spread difference when basically I took one data minus the other. It shows when it's positive or negative, and I did the advanced decline line. Let me just quickly also mention what's interesting to me with this is all these moving averages, the 20 above the 50, the 50 above the 100, the 100 above the 200. So we now have structurally what is an uptrend. It's the DNA of an uptrend when the faster moving averages are above the others, and we have that August high that we're not too far away from that is just kind of lurking up there. So anyway, hope everyone has a great day. I'll see you again next week. Sorry if some of this was disorganized at all, but it's interesting, just some of these signals I had seen hadn't been working. And when you're in this low volatility sort of market, these kind of squeezing moves might be more of what we get and less of the kind of pullback and continuation. Things pull back, they take longer to bottom. That's why I'm watching Microsoft. I'm not really sure what to make of it here. I'm not sure if it is an entry here, or maybe it needs to basically, pay its dues for a few weeks and then rally out of the Fed. But this market is at this point a spot where it does seem that money is leaking off the sidelines. And I do think that the combination of the lower VIX and this shift in the AAII sentiment is a big deal. This is not a normal sort of shift. This is a significant change. So this is not a normal sort of shift. This is a significant change. So hope everyone has a great day, and I will see you next week.